short of it is...
Absolutely. How about at the end of the day?
Welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Good day, good evening, good afternoon, good morning, wherever you are. Hello and welcome to Rask Live for this week. I see that Deepak did say that we've set a new record for starting a few minutes after the deadline. So thank you for bearing with us as we set up a few things. We've got heaps of wonderful charts and graphs to visualize what it means to be an ETF investor. So we'll be joined today by Tom Wickenden from Betashares as we talk through basically all the different types of ETFs you might come across. We can talk about portfolio construction and all different types of things as it relates to ETF investing. And we're basically asking the question of like, how the ETF did we get here? It's no surprise to many of you that ETFs have really taken the investing world by storm over the past, maybe say 10 to 20 years. So we'll find out why that might be the case and how investors are using them in 2023. So I can see Karina's already got in with the question, what is the difference between an ETF that follows an index and an index fund? Which one gives more return? Those are good questions, Karina. We will have time for questions with Tom after a short presentation. But before we get to Tom, before we cross to him, I've actually got a few slides of my own that I wanted to share with you. So as you know, we go live every Wednesday, sometimes at 6 p.m., sometimes at 12 p.m., sometimes at 12:08 p.m. Depends if we're running it scientifically to time or not. So if you haven't already subscribed, no matter where you're watching this, if you're on Selfwealth's YouTube channel, the Rask YouTube channel, Twitter, Facebook, LinkedIn, the ASA YouTube channel, wherever you are, don't forget you can subscribe and follow along and you will receive notifications every time we go live. Here's this week's joke. My wife hated my impulse purchase of a revolving chair, but then she sat on it. Eventually, she came around. That is my joke for this week. And indeed, I am sitting on one of these chairs right now, ergonomically designed too, I might add. So this one's close to home because my wife is also an OT, an occupational therapist. So I'm sure she'll appreciate that one, and I can maybe share it with her so she can try it on with her colleagues. Okay, Rob's given me a 9 out of 10 for the joke. That's actually pretty good over on the Selfwealth channel. So Rob, thank you for that. G'day, Salah. Welcome to the chat. We have a lot to get through today, but if you did notice earlier on, I did put a bit of a link in the Google, link to a Google form in the chat here, and it goes to this page, which helps you and helps me get better, I guess, content and information across to you in 2024. We do these surveys basically every few months at Rask, but also on the Selfwealth live channel. We've done a couple in the past. And so if you just take a few moments either now or after the live is done, it only takes maybe 1 or 2 minutes, depending on how long you want to commit. What we're trying to understand from people going forward is we're trying to understand some of their biggest regrets and successes with money or investing so that we can try and help more people avoid some of those mistakes and share in some of those successes. So that's the survey we've got going on so far. So if you could, it'd be great if you can help me out. Okay, coming up on Rask Live for the remainder of this year, we have the Christmas special that will come up the week of Christmas in the lead up there. We've got property and shares next week with Pete Wargent, one of Australia's best property economists. Some might say the best. He's also a property coach and he co-hosts the Australian Property Podcast here at Rask. Today, we've got nothing but ETF Q&A with Tom Wickenden from Betashares. Tom's appeared on the Selfwealth Live program, the predecessor to Rask Live, and I got to admit some of the slides he brought that day were some of the best I've seen, at least the best on the live series thus far in the years that we've been running it. And you're probably thinking, yeah, well, Owen, your slide game's pretty good, but it's not as good as Tom's, I can assure you that much. Don't forget there's free stuff up for grabs, or you can get a ticket to this week's Finance and Fizz event in Melbourne with Ladies Finance Club. You can use the coupon code RASK on the Humantix website. Just Google Ladies Finance Club Melbourne event. Use the coupon code RASK. And Major Street Publishing, many of you have already taken this up. Maybe 50 or 100 books have already been sold through the Rask Live. But if you just Google Major Street Publishing business books, last week we had the author of the Ulysses Contract, Mike Kemp, on the show. Kate Campbell, my co-host, has written the book Buying Happiness They're all available through Major Street Publishing on their website. You can use the coupon code RASKXmas and get it 50% off. So who knows, your accountant might even say it's tax deductible if it helps you earn passive income into the future. And that's it for now. We'll save Charlie's quote for later. And right now, I would like to welcome Tom Wickenden to the Rask Live program. So Tom, welcome, mate.
Good morning, Owen. Morning, everyone. Thanks for having me on. Always a very kind intro. Owen, I was going to make a counter joke to your dad joke, but I'll leave it out because you're kind to my graphs.
Okay, well, that sounds fair to me, mate. So today we're going to be talking ETFs, everything ETFs. Obviously, people familiar with the Betashares name here in Australia, the largest ETF issuer in the country by number of ETFs, and one of the biggest in terms of capturing more of investors' dollars. So you've got a wealth of data, knowledge, and experience in talking with these things. We did a podcast together recently as well. So I actually have some of your slides locked and loaded, so you can guide me through these. And this is actually for everyone's benefit. This is actually a real treat for me because normally I do have to try and use some artistic flair and put together some slides. But in this case, I get to lean into Tom and the talented Betashares team to do this. So, mate, I'm going to bring this up right now, and you can just nudge me through it. And for everyone else's benefit, we are going to answer your questions towards the end of the live stream, so we can try and get through this. But if you do have some questions to kind of follow up with Tom on a key point as we go through, please let me know. And as always, if you're watching this on replay, as many hundreds, if not thousands of people will, you can leave your questions in the comments and I can take a look at them after the fact. So, mate, where do we start?
Awesome. Yeah, well, I mean, there's a lot of data, a lot of stats, a lot of figures thrown around about how big the ETF industry is getting, both overseas and here in Australia. And so what I wanted to do with this presentation is just take a step back and using some of the data we have in-house, just look at where has this growth actually come from. I think it was Karina who mentioned, what's the difference between an ETF that follows an index and an index fund? It's a really good question. This presentation tries to break down the different types of ETFs that are out there, because some of them are index ETFs, but there are other types of ETFs as well. And when these different types of ETFs have contributed to the growth of the entire industry. So we can kick off and scroll down a little. I think we've already given the usual disclaimer, but I better give one myself as well, just to note that everything in this presentation is general in nature. None of it constitutes financial advice. I don't know any of your personal circumstances. So yeah, just important to consider that.
And of course, read the product disclosure statements and target market determinations on the Betashares website.
Please do. Thank you, Owen. You saved me a headache with legal there. So this is it. This is the ETF industry in Australia. You can see, very small growth initially. So in the first month, the industry grew by $100,000. In the first 10 years, $5 billion. In the 10 years following that, $145 billion. So wow. For any investor, it is very hard and maybe not responsible to ignore the substantial growth of the ETF. And I'm sure a lot of your viewers will know, but ETF stands for Exchange Traded Fund. So a fund that trades on the exchange, to read it backwards. The growth of this industry. Yeah, amazing growth. Like, just to give some perspective, so like I mentioned, that first month, for instance, the entire ETF industry grew by $100,000. Last month, Betashares grew by $1 billion. So we're just seeing incredible growth. Our fastest billion to date, 17 days or something. So it really is incredible. So I want to educate investors on where this growth is coming from in terms of the different types of ETFs. We can dive in, I reckon, Owen. What's next? The agenda. Yeah, so to break down the different, or break down where this growth is coming from, I wanted to look at the different types of ETFs. I'll go into each of these in more detail as we go through, but that just gives you a nice overview. We can jump to the first one, which is what I've called the bedrock of the Australian ETF industry. And it's fair to say this is the bedrock of the global ETF industry as well. Owen, you'd probably agree that when most investors think about ETFs, and again, this comes back to to Karina's question, most investors think about index ETFs and pretty broad index ETFs. What I mean by that is, the ASX 200, a broad index, the S&P 500, the NASDAQ 100, even the MSCI World. These are broad market capitalization weighted indices. And that's what I've defined here as broad equity index ETFs, the first category. And the growth of ETFs globally has really been synonymous with the growth of core or of passive investing, passive index investing. So if we scroll down, what you can see is the majority of the ETF industry in Australia, and apologies, the colours have come through a little bit funny there.
It has,
you can still get the idea. So around 40% of the total ETF industry in Australia is made up by what I define as these broad equity index ETFs. Of the 10 largest ETFs in Australia, 8 of them fall under this category. Most of them are following indices I named earlier, so like S&P, the NASDAQ 100, ASX 200. And those 8 largest, of the 10 largest, 8 of those are core, and those 8 largest actually account for 30% of the total fund of the entire industry. So, I mean, right off the bat, you can see that is where the majority of growth has come from. And it's really been due to just, over the past 20 or so years, there's been a lot more education around the benefits of passive index investing. I don't want to go into it too heavily in this presentation. It's not really what it's about, but this greater education that's been given to everyday investors and professional investors has led them to more and more often invest in passive indices and start to forego potentially higher cost active managers. And this has just happened to coincide with the growth of exchange traded funds. Prior to exchange traded funds, there were just index funds, Karina, to your question. Those were unlisted funds that aim to track an index. The difference between that and an exchange traded fund isn't what it's aimed to track, but it's the fund structure. Because at the end of the day, an exchange traded fund is just a structure of a fund. You can have actively managed ETFs, which we'll go into. You can have fixed income ETFs, passive ETFs, commodity ETFs. The ETF itself is just a fund structure, which comes with some really, really awesome benefits, such as everyday liquidity, like you expect from your shares since it trades in the exchange. It's a fairly tax-efficient vehicle as well, and it also has this creation redemption mechanism that means it tends to trade at fair value. So, the introduction of exchange-traded funds to the world of finance coincided with the education of the benefits of index investing. So, two have just paired together really nicely.
So, Tom, can I ask a question? So, just to give an example for people, what you would consider here in this core area, this is supposed to be orange, so apologies for that. But what you would consider there is, say, like the A200 ETF, like your Australia 200 ETF. That's
exactly right. So, two of those largest 10, for instance, one of them is the A200 ETF, our Betashares Australia 200 ETF. So all that is really low cost access. You're talking 4 basis points per annum, like $4 for every 10,000 invested. That was less than my coffee this morning in Melbourne. And our NASDAQ 100 ETF is another example of core low cost broad market ETFs. Good to remind me to bring those up. Thanks, Owen. So that's the better. If we go to the next slide, please, Owen. I've just touched on, and I might chop and choose as to how much detail I go into each of these slides. But just to take a step back, this is more, I guess, investment education rather than about the growth of the ETF industry itself. But when you're looking for a core exposure in your portfolio, you really want to tick a lot of these boxes because the core is meant to be held there for the long run. So you don't want high fees. You want to actually provide exposure to what you're looking for, because typically the starting point is your asset allocation, right? I want to put X amount in Australian equities, Y in international equities, Z in fixed income. You want to make sure the securities you use in each of those baskets are actually tracking that asset class, and passive index ETFs are great at doing that. So that is, these principles really align with the principles of core equity index ETFs, and that's why we've seen this massive growth of that type of ETF.
We see a note here from Rob on the Selfwealth channel to say that Selfwealth investors have $350 million invested in NDQ, which is the NASDAQ 100 ETF, and A200 alone. So,
yeah, wow. There you go. I just found out myself yesterday that NDQ is held by the most amount of investors. So almost 200,000 different Australian investors hold NDQ.
Wow.
Which is pretty amazing.
Wow. Okay. I like it.
So if we roll on, cool. This is, look, I won't stand this too long. This just gives you an example of what we classify these core ETFs. And we've already talked about A200. We've talked about NDQ, which is the first and third columns there. The other two, I'll probably focus on DHHF, which is a really interesting one potentially for this audience. It's what we call a diversified ETF. So it's actually an ETF holding different ETFs, a bit like ETFception. The premise is, with that one ETF, you get access to Australian equities, international equities, both developed and emerging market. And so it's what we call an all growth ETF. You get access to over 8,000 equity securities in one purchase of a single ETF in the exchange. So it's just a really efficient way to invest at a really low cost of 18 basis points. And that's, that type of investing has become so popular, and that's why I've seen such strong growth.
Yeah. And I know that this is a really popular ETF amongst younger investors in particular, and people that have got a very long runway before they plan on retiring. And as they go on, they tend to complement it with fixed income and those types of things, which we're going to talk about soon, which is this one here on DHHF. And there was a question that came through about the fees for core ETFs. So you can see that Tom's laid them out there for you as an example as well. So that kind of covers that one. I thought this was interesting, not only because of the image, which looks like it was AI generated, but also the slogan.
Yeah, exactly right. I might just, there's been a few other questions come through. I've just noticed around currency hedging. And so, for instance, we've got like a currency hedge version of that NASDAQ fund, and that would also fit in that previous category. And at the moment, we are seeing, this was a question, from, I should leave the questions to you, but Mike Smith asked, we noticed the difference in inflows given the way the currency is at the moment. We don't really see people go from Aussie to international. We usually see people go international hedged or international unhedged. So there might not be enough context around answer that question, but I thought I'd just jump at it while we're there.
No worries. So what you're saying is, like, a lot of people like Mike and myself, for this matter, Tom, we're thinking if we're investing in the United States, the currency, if anyone that is looking to travel overseas, it's become very expensive because the Australian dollar has fallen a little bit. And so people are now thinking, well, maybe I can hedge my portfolio. Now's the time maybe to start thinking about that. So you're seeing people switch to not switch maybe, but just think about the currency hedged version of things like NDQ.
Yeah, in terms of net new inflows into the industry, we're seeing a lot more go towards currency hedge exposures because, as you put it, if the Aussie appreciates from here, that will eat into unhedged international returns.
Yeah, good point. Okay.
Right, but so back to the AI-generated dog in a suit. This section is around the second largest category of ETFs, which are active ETFs. So people are probably familiar with actively managed funds. There are stock pickers. They go out, they do their analysis, and they choose the stocks they want to buy, and you can buy into their funds. Well, as I mentioned, you can have active managers use the ETF structure. And we've seen a lot of growth in active managers converting their funds into ETFs. This section comes with a fairly important caveat. So although active ETFs are the second largest category behind core ETFs with 15% of the assets under management in the Australian ETF industry, 90% of that has come on fund conversion. What that means is if there's an existing active manager with an unlisted fund and they convert to the ETF structure, obviously that becomes part of the AUM of the ETF industry. And so 90% of the total AUM has come from conversions. The remaining 10% has been net inflows. If we look at a shorter time period, we look over the past 3 years, as I did in my analysis, we've seen a huge amount of conversion of unlisted active managers to ETF structured active managers, and also new actively managed ETFs coming online. Even active managers, I think, are seeing the great benefits the ETF structure offers, And so I expect to see this continue a lot. I think this would be due to that conversion factor, probably one of the largest growing categories of ETFs by terms of AUM. But in terms of net inflows, we're seeing a slightly different picture. So although the number of active ETFs doubled, or more than over the past 3 years, over that time we actually saw $2 billion of net outflows from active funds. It goes back to some of what I touched on earlier, this passive v active debate and the education around that. But it's a trend we're seeing alongside the growth of ETFs. We're seeing huge flows into listed ETF vehicles, huge outflows of unlisted funds, and we're also seeing big flows into passive funds and sizable outflows from active funds.
So it's really interesting. So for people's context, I think this deserves a double click because you mentioned some really good points here, Tom. What Tom's saying, guys, is that a lot of fund managers who pick stocks and do all that type of active management, they are recognizing too that ETFs are growing considerably. And this goes back to Karina's point at the very start. Like an ETF, as Tom said, is just the structure, it's just the wrapper. And what goes inside it is what you should be paying attention to. And so this is really interesting in the sense of like where this could go. Like, in my opinion, just my opinion only, Tom, that I think that most active fund managers in the future will have to have an ETF version of their strategy because we'll all demand that you can buy it through your brokerage account and through your platform. So just to chime in with 2 cents there.
That's exactly right. It's probably worth just on that graph there for one more second on the one above, just worth mentioning, like for instance, just to try highlight what I mean by this. So this is the total AUM of active managers in ETFs. That huge jump you see, which was, I think it was just around 2020, was it? That huge jump, that was a particular active manager converting to the ETF structure. So we saw a huge increase in the AUM during that period. But then you can kind of see, outflows following these conversions.
Yep. And this is kind of here again.
Yeah, exactly right. So we don't need to go over this too much, but this is just showing the inflows into the first category we looked at, so core passive ETFs in the orange bars. So fairly strong inflows over time. And then we see the outflows from active managers. So particularly over the past 3 or so years, you can see those blue bars being quite negative. It's just showing the flows between passive and active ETFs.
And what it basically highlights is that people always say in the news, like the fund managers or whatever, they'll come out and say it's a stock pickers market. But this would actually show that when the market has struggled, actually people are taking their money out and they're putting it into these core ETFs, these long-term ETFs, which is quite interesting.
No, we could do it. We could do a whole nother webinar on that line, a stock pickers market, but we won't. We'll just focus on just ETFs today and where the growth has come from. So this next category is probably the category I'm personally most excited about going forward. So let's take a step back and think about those first 2 categories. So historically, we've seen lots of money flow into active managers. People want to, use funds that can outperform the market. Previously, there wasn't index funds available, sure, but there's always been a strong desire to, outperform the market, which is natural for investors. Using the core index ETFs, which have seen the most growth, that is the market. Okay, so that's what we consider the market. Education is able to buy that. But if you're an investor sitting there saying, okay, I've got my money in those core passive ETFs, that's great, I'm getting market returns, but you know what? I still want a little bit more. I don't believe that active managers can persistently outperform, which is what a lot of studies show. So what can I do? And this really but this exciting category of ETFs kind of lets you have the best of both worlds in a way. So smart beta ETFs, if we scroll to the next slide, Owen. So this kind of illustrates what I was just talking through. So the blue line there is the market, your core ETFs, and the grey line is an active manager. So you can see that active managers, and this is a quality active manager, during particular parts of the market cycle, that manager does provide outperformance over the broad markets. That's the MSCI World. The MSCI World is just a broad market capitalization weighted index. Mm-hmm. However, indices now don't need to just be that passive or that vanilla. They can be a bit smarter. They can be a bit more targeted in how they select stocks. What I mean by this is still using a passive strategy. So still an index methodology that says we will buy this stock and that stock depending on these variables. But instead of it saying we'll buy the largest stocks listed on the ASX 200, we can say we'll buy the stocks that have the highest quality metrics in the world. So if you scroll down to the next slide, this orange line here, which has, you can almost not see the grey active manager line anymore because that orange line is mirroring it. That is a passive ETF that's just tracking what we call a smart beta index. So it's aiming to do the screening processes that active managers would do to screen for a universe of quality companies, but then not undertaking the stock picking afterwards. And what you can see is you can get active like returns, but from a passive index ETF, which has some pretty significant advantages. If we look to the next slide, Owen, you'll see this on the bottom right-hand side. I've just jumped cameras, but on the bottom right-hand side there, you can see the fee load of the 5 largest quality active managers and the fee load of Betashares QLTY. So this is our global quality leaders ETF. And you can see you're getting, actually, against these 5 largest quality managers, a better outcome than all 5 at a lower fee and typically at low levels of concentration. So
that's really quite interesting, Tom. Sorry, just to jump in real quick. That's quite interesting there because you're basically illustrating, and I think you've got a slide on this, and I was commenting on off air about this, but this effectively here, what you're saying is like you're getting a similar performance in this time period, which looks like about 5 years or so. 8 is 5 years. You're getting a similar performance and risk outcome from your investment, but at a much, much lower fee load, which is arguably like where you're kind of trading off. Like, what are you getting for the extra fees that justify that return? To your point around, like, you can use this kind of like regimented process of like following index, smart beta index in this case. And because you do that, rather than having the fund managers and their analysts and their team, you can actually lower costs and deliver similar outcomes, which is really impressive.
Exactly right. And it kind of raises the question, which is a slide we'll come to, which you alluded to. We can even jump there now, actually. I think it's the next slide down. Yeah, it kind of raises the question, okay, we kind of know, we hypothesize that most active managers, they start with a broad universe of stocks, and then they have, certain metrics they'll screen for to make that universe smaller, so they can do, their stock picking processes on a smaller number of companies, right? So step 1 here is that screening process. It says, okay, here's all the companies in the world. Please give me the ones that have the highest return on equity, that have, the greatest earning stability, that have the lowest, levels of leverage or reasonable levels of leverage. And that filters down to a more condensed basket of stocks. And what a smart beta ETF will typically do, it'll say, okay, we'll now just hold that whole basket of stocks and we'll put a stock cap on it. So for our Betashares Quality Leaders ETF, we put a 2% stock cap. So it means you're fairly well diversified across the basket. And that's it. That's where it stops. For active managers, they then say, okay, we're going to hire a team and pay a team of, financial professionals to undertake lots of research and on specific companies. And in doing so, we're going to choose the best companies in that basket of 300. And, hopefully then we should outperform. What we're finding is that they don't typically outperform in that second stage, and it just costs higher fees for investors. So it's why I'm really excited about this style of ETF, because I, like many investors, would love to outperform by targeting particular factors over the course of the business cycle, and these types of ETFs are allowing us to do so. So if we jump to the final slide on this section, Owen, you can see it's been a pretty, one more. We can skip over that one. That's fine. It's been growing fairly steadily, the assets under management in this category. So it now makes up about 11% of the total AUM. I would expect, notwithstanding, as I mentioned before, the conversion FUM growth we'll see from active managers, I expect this to be the other fastest growing segment of ETFs in Australia, if I had to pick one.
Yeah, cool. And we're going to see more things like quality or different factor style ETFs potentially, being used by investors, which is really neat. And we kind of see that in the US experience, right? Like we see a lot of that, like momentum ETFs and those types of things.
Yeah, I mean, compared to just in general, when you look at the US ETF industry, there's an ETF for everything. There's even ETFs now on individual stocks, which we haven't got to that level here yet in Australia. But yeah, they've got every factor under the sun. I think there's someone told me it was 300 or something identified factors now, apparently, and I reckon they've probably got close to that many covered in the US market. We're not quite there yet in the Aussie market, but I'm sure we'll see more of those mainstream factors come out, like momentum, for instance. I'd be surprised if we didn't see a momentum factor come out soon.
Yeah, for sure.
Yeah. And so this one, thematic ETFs, I've labeled the surprise. So thematic ETFs, I think it's fair to say they get a large amount of the media and a large amount of interest from investors. So much so that I had hypothesized that they would make up, a fairly decent chunk of the Australian ETF industry. I would have guessed maybe around 5-6%, which is typically what I would kind of hold as thematic ETFs in my portfolio. Was kind of my logic. Thematic ETFs, they're a really great access vehicle. So if we jump to the next slide, when we talk about, I should probably provide some scope. Not everyone will know. So when I talk about a thematic ETF, I'm talking about an ETF that's giving you access to typically related equities in some type of future growth area. So you can think about, global cybersecurity. There is an ETF that tracks the largest global cybersecurity companies.
Mm-hmm.
And I'll call it a thematic ETFs. There's electric vehicle ETFs, climate change innovation ETFs. These type of themes fall under this category. And they're really good and really beneficial for a well-diversified portfolio because they provide access to, long-term, potentially high-growth strategies. They're fairly, that usually don't get access to these companies in broad market indices. These ETFs tend to be pure play. What I mean by that is they target like the smaller companies that really focus on that area. Because, of course, if we think of the largest tech companies in the world, well, they're actually some of the biggest cloud computing companies, some of the biggest cybersecurity companies as well, if you know about Microsoft cybersecurity and the amount of work they've done there. But these ETFs tend not to hold those larger companies. They look for more pure play companies to give a good exposure to the particular thematic. So I guess to summarize, they're really good diversification piece and access vehicle in portfolios. And if we scroll to the next slide, please, Owen. Thanks, mate. So yeah, given the color differences, and this is almost quite relevant. Or I can't think of the words off my head, but almost quite relevant. This has happened. You can't even really see the thematic ETFs AUM in this slide. Maybe on your screens it's a bit bigger, but that little grey bar along the bottom is the amount of assets under management in thematic ETFs compared to the entire Australian ETF universe. So it sits around 3%, which, as I mentioned, was surprising to me given the amount of media we hear and interest we hear in thematic ETFs. It's probably lower than I would have expected.
Wow. So that's, when you think about that, how much do investors talk about different thematic ETFs, right? You see people talking online, talking to their friends. They're always interested to talk about the latest and greatest industry, AI, these types of things. But then you see it in action, and it's actually, I didn't realize it was actually that small as a consideration.
Yeah, no, it's quite, and just it goes to show that I guess the bulk of investors' money is going into those core building blocks, which is good to see in a way. Thematic ETFs are great, but they are high growth, so they're more high risk and highly volatile. So you typically wouldn't, again, I don't know any of the individual investors' situations on here, but you tend to hold a smaller portion in your portfolio in thematic type funds, those higher growth, higher risk type funds.
Yeah, agreed.
Yeah.
And yeah, it's if you're watching this and you're thinking, well, what's my exposure to these things? Well, you can kind of get a sense from what Tom's put together here of what the industry as a whole and what investors as a whole are doing. It might give you kind of like a reality check on maybe where, you can think about your portfolio going in time. It's cool. I like that.
That's a good caveat. Yeah, great. And so that brings us to It brings us actually to our suite of thematic ETFs we have here at Betashares. So like I mentioned, they are amazing access vehicles, and they're good. The core of the portfolio, although that's the bulk, for a lot of investors, they especially investors on this webinar, are probably pretty engaged, pretty interested, and like to be a bit more hands-on. And so it's awesome to do some research into areas you like and add these to the portfolio. Because that core part of the portfolio, which we talked about earlier, you kind of want to just be a bit boring and stick to your asset allocation and not really do much else. This is where you can have a lot of fun around the edges.
I know that we've spoken in the past about Hack in particular. We've spoken about Asia last week, I think it was. We spoke about RBTZ a few times as well. So those definitely, imagine most people that are watching this would be familiar with those ETFs, but there's a whole heap in the suite there.
Yeah, well, almost contrary to everything I've just said, Hack, our global cybersecurity ETF, is actually our fourth largest equity fund.
Wow.
Just to undo everything I've just spent 10 minutes saying, there you go. That's not a large part anyway. And that brings us to the final broad category. I looked at a few more. This is the final one I wanted to talk about, and it was fixed income ETFs. And I think on the podcast we did recently, Owen, I might have brought out this statistic. And the statistic was last time the Australian 10-year government bond yield was at 5%, which was back in 2012. There was 0 cash and fixed income ETFs available in Australia, and today there are 53. And due to that, I've labelled this category, a new era, because we've entered a new era for fixed income. We've seen yields at levels we've not seen for over a decade, which is really interesting. At the same time that we've got cash and fixed income ETFs for the first time. So on that first point, since yields have increased so much, and we're missing the number. Oh, yeah, you can kind of give you an idea. So the first grey bar in each of those categories, or for the first 5 bars, is just showing us the yields about a few years ago on, fixed income securities, which were really low. It wasn't much in fixed income, and how much those yields have increased today, particularly compared to those final 2 bars, which is showing us the yield or the earnings yield on the market. So the earnings yield on the market's barely gone up, but for fixed securities, it's grown a lot. So that means on a relative basis, fixed income has become a lot more interesting for a lot of investors.
So I might double click on this and just confirm what you're saying, just to make sure I've got this correct. Effectively, you're showing like the yield across. In this case, we've got the RBA interest rate. We've got government bond yields here, inflation adjusted. Then we've got like corporate bonds by the looks of it, senior banknotes, and then it keeps going on and on and on. But then at the end here, this is for the stock market. So this is the US stock market. This is the Aussie market in terms of dividend yields on average. And what you're focusing on here is the change between the two. So even though the stock market still yields quite respectable amounts, it's actually the growth in these other ones which are quite interesting as well, because you're seeing some of those bonds start to yield a lot more and get a lot more interesting for people.
That's exactly right. Yeah.
Yeah, cool. I love how you've I didn't actually, when I saw this chart come through, I wasn't actually 100% sure, but this is a really good representation of what people can do with their portfolios with ETFs now, right? Like, you now have the defensive side of your portfolio, which is invested in these types of things, all of a sudden yielding much more than it was previously.
Exactly right. And so, this, availability of fixed income and cash ETFs, which has been around for a little bit longer, but coinciding with this new fixed income market, if we scroll to the next slide there, we can see that we've seen huge amount of inflows into listed fixed income exposures. So this is really drilling into that stat that I mentioned earlier. So, 10 years ago, investors had no option but to use unlisted fixed income exposures for their for getting their fixed income on that defensive part of the portfolio. What we've seen over the past 18 months with the availability of fixed income ETFs, we've seen pretty substantial outflows from unlisted fixed income exposures, which are the black bars, and pretty consistent inflows into listed fixed income ETFs. So this kind of comes back again to that discussion we had right at the start about an ETF just being a fund structure. And investors' preference for using a listed structure rather than an unlisted structure because of some of the benefits we touched on earlier. And ETFs are that main listed structure that investors are using.
Yeah, so people are now able to build full professionally styled portfolios in effect using their own platform. Like in the past, to access these types of things, you'd have to fill out the paperwork on a website or see your financial advisor. But now all of a sudden you can do basically all of the core components just in one place, which is pretty amazing.
Yeah, exactly. I mean, they're just amazing access vehicles to a whole different, all different asset classes now, which is great to see. And given what we just kind of talked about, the how interesting the fixed income market has gotten, or how more relatively attractive fixed income assets have become, we've really seen substantial growth in fixed income ETFs over the past 12 to 18 months. So the past 12 months, almost 60% of the net flows into the Australian ETF industry have come from cash and fixed income ETFs, which is pretty remarkable. Historically has always been dominated by equities. What this is saying to me, what I take away from this is, in the earlier days when there were equity ETFs available. Remember that very first chart? It took quite a while for investors to start using equity ETFs. There was pretty flat growth for the first 10 or so years. As investors became more comfortable with those, they started using these core passive ETFs. They started using some smart beta ETFs and active ETFs. So they're more comfortable with the structure. And as we enter a new fixed income market, they're saying, okay, I'm comfortable with the ETF structure. I can see there are cash and fixed income ETFs available. That's the obvious place for me to go now. So it's really good to see continued adoption across different asset classes for ETFs as investors' education continues to grow.
Yeah, I love that. And it's like you've said, like people have already recognized that ETFs are the future of investing. They don't need to be convinced on that anymore. It's just making these fixed income ETFs available to, say, retirees or would-be retirees who are looking for passive income. They're just them being there and the financial advisors recognizing they're an option has been enough to just encourage and foster this rapid adoption, which is great to see.
Yeah, that's exactly right. And look, I won't go into these in any amount of detail. You obviously, I'll be recording this after, so you can pause on this slide if you're interested. But at Betashares, we've got the largest suite of cash and fixed income ETFs available to the market. I can see Hammer had a good question around one of our newest funds, which is our money market ETF, which we might get to in a second. But this just shows the level of availability just from Betashares across fixed income ETFs now. It's quite amazing. We've got cash ETFs, cash at the bank, and money market securities. Across to bank hybrids, we've got corporate bonds, we got US bonds, we got inflation protected US bonds. So again, it just talks this. I think the overriding message as we get to the end of the presentation part of this webinar is to say ETFs are just a great access vehicle that are more and more giving investors access to different investment strategies. And we see, and as investors become comfortable with that, they're using them more and more. I think that's just that access vehicle point is really important.
Yeah, absolutely. Having it available is the kind of that's what we needed as individual investors, is the ability to invest in these products, these professional ETFs that we could now add to our portfolios. I love it.
Yeah, exactly right. So look, that kind of sums up everything. I wanted to cover at a high level. Anything from you, or maybe we open to questions, or whatever you feels best.
What I might say is that people can head to the Betashares website. If you come across anything that Tom or I mentioned today and you want to learn more, you want to request a fact sheet, you want to look at the PDS, head to the Betashares website, because there's even some great tools in here. I know you've got the comparison tool as well, where people can put ETFs side by side. So head to the Betashares website if you are confused, and of course read the product disclosure statement. And one final warning: we will have some time now for some questions for Tom, guys. So please get your questions into us now. But maybe we can start with Hammers, who did ask about the MMKT ETF versus AAA, which is one that Rob was mentioning earlier on, saying from Selfwealth, Betashares AAA is the favorite among Selfwealth millionaires, which is quite an endorsement. but now you've got MMKT. So maybe it's a question from Hammer of like, what's the difference between this and say AAA?
It's a surprisingly interesting question, given we're talking about cash, because for a lot of investors, when we think about cash, we think about dollars in our hand, money in our bank account, and we can extend that to, let's say, term deposit accounts, and that's what I think probably a lot of investors would think about as cash. But the finance industry defines cash a bit more broadly than that. That's one part. There's also what we call money market securities, which are generally very short-dated securities issued by governments, banks, and some large corporations for short-term funding requirements. Now, what MMKT is, it's access to the whole universe of cash, traditional cash and money market securities. So this still fits in the cash, asset class and the core cash part of your portfolio, because we classify these instruments as cash-like. So to your question, Hammer, AAA is just going to be purely cash in a bank account and in short-term accounts. So that traditional thought process for many people. Money market extends it out to hold these money market securities, and what that means is you're taking on a little bit more of perceived risk, but you are receiving a little bit higher income. You can see the average credit rating there, A-1. Some might not be familiar. This is a short-term credit rating, which is different to your traditional, AAA plus. That's the highest short-term credit rating you can get. So it's still the highest credit rating you can possibly have for short-term credit, and you get a bit of a pickup on the yield of AAA. Again, coming back to this access vehicle point, if we look at what large institutions, both here in the US, use for their cash allocation, they use lots of money market securities. And traditionally, everyday investors couldn't really access these securities, but money market, the new fund, gives that access. So it's really awesome. And again, using the US as an example, they just reached a record number of assets under management in their money market funds over there. There is US $6 trillion now in money market funds in the US, which is just incredible.
Unbelievable number. Trillion with a T.
Yeah, I know. A US trillion as well. Insane.
Yeah. I might step in with one maybe final question for you, which is that, is there anything else about the future of ETF investing that's really interesting to you? So we've obviously seen people using ETFs for broad share market core ETFs, as you mentioned. We've seen thematic, smart beta. Some active fund managers are offering their investment portfolios inside an ETF structure. We've got this rise of fixed income, particularly in 2023, in terms of people piling in. Not necessarily a forecast, but what are you watching in the future? What are you looking at and thinking, well, that's something that investors should be able to keep an eye on, or should be interested in keeping an eye on?
Yeah, it's a really good question, because I do like to keep an eye on those opportunities. And one that stands out for me, and one that I'm just personally really interested in, is something called direct indexing. And we might have even talked about this before, Owen, but direct indexing is the possibility for investors to create and modify their own indices and have a fund track that they can buy into, which is a really cool concept, and it would be a really cool future iteration of ETFs. So if we, for example, right now, say some of your investors are using the Australia 200 ETF, the A200 ETF, which tracks a pretty passive, pretty vanilla index. With direct indexing, I could go along and say, okay, I like the ASX 200, but I don't want much fossil fuel exposure. Or, to our earlier example on smart beta, I want the companies with the highest return on equity. I don't want fossil fuel exposure, and give me, 5 of the best companies in the 300 as well. And so you're making these more specific rules for your index that, an individual index provider isn't going to put out a fund that niche, because it might only appeal to a few people. Well, with direct indexing, that may become possible, where investors can create their own rules for their funds they're tracking, which I think would be a really interesting thought experiment as well, because we've already talked about how some active fund managers, or most active fund managers, can't beat the benchmark. And I think a lot of investors would play around with direct investing and be it for, I think ESG is a big application of it, but also, individual investors trying to outperform the market. It'd be great to see, how many could do so, or if you and I could even do so, Owen, or we'd be back to the broad passive indices in quick time.
Yeah, because this is, again, maybe following the lead of the United States. For folks that don't know, this ability to like tinker, let's call it like that, or modify your ETF and your portfolio quickly and easily could be something that's like here in Australia. I know Betashares are super innovative in this way and kind of like democratizing access to all these types of things. So if you want to follow along, not just with what Tom produces, there's a free insights tab on the Betashares website, but you can subscribe to the Betashares newsletter. There's a fun comparison tool, which I don't think we've shared much on the Rask Live show so far, but I'll probably be using it more in 2024. You can actually go onto the Betashares website and you can put ETFs side by side and compare them for a range of different factors that you'll want to look at. So go and check those out. Don't forget the product disclosure statements and TMDs on there as well. But Tom, this was heaps of fun, mate. You and I get to chat regularly. Thanks for bringing your slides. Sorry about the color. I know how good your slides are, but converting it to Canva caused me a few headaches. And I really appreciate it though, mate, because you're a wealth of knowledge. And if I don't see you before Christmas, Merry Christmas. And thanks for joining myself and everyone here in the community today.
Thanks so much, Owen. Always a pleasure to join, and I love your engaged audiences. So Merry Christmas to all, and hopefully see you all again in the new year.
Cheers, mate. Cheers, Tom. Thanks for joining us from Melbourne. All right, that was Tom Wickenden joining us from Betashares. I would highly encourage everyone that's watching to check out the Betashares website, in particular the fund comparison tools there, because they make a lot of sense from like just to be able to visualize things side by side. Maybe you want to look at performance, maybe you want to look at other factors. So go and check that out. And a lot of the things that Tom referenced today, I know there was a question here from David about sharing the slides. Apologies if they were blurred. Sometimes on YouTube, David, you need to turn up the resolution of your own screen in order to see the full. You need to adjust it in the settings. Sometimes YouTube doesn't feed you the full picture. But if not, a lot of those slides, in fact, most of the concepts that Tom was talking about are available on the Insights tab of the Betashares website. Like a lot of that data is on there for like fixed income and for the different types of ETFs and the industry as a whole. So go and check those out over there. But I just want to maybe double click on the other slides that we had. So I've got my closing quote for this week, which is from Charlie Munger, the late Charlie Munger, may rest in peace. He said, "It's easier to avoid stupidity than it is to seek brilliance." This is the same quote that I used last week, and I did it deliberately because today we're talking about ETFs. And I think in the investing industry, what I've come across after doing this for many years and interviewing hundreds of people, which is that the investors that tend to do the best and actually create wealth for themselves and for their families, these people are the people that are the most humble in the way they go about their investing. They're not out there bragging about which stock they bought or what they did at a particular time or how they time the market. They're the people that just continually put $1,000 into their investing account a month or into their favorite ETF. They chuck $5,000 in, or they get a dividend and they reinvest it. Those are the people that do so well, in my experience. And even the really wealthy people. And I often think to myself, it was a really interesting thought exercise. If someone walked up to me, on the street today and they gave me $10 million, what would I do with it? And I often think to myself, well, the easiest answer is I'd put almost all of it into ETFs, most likely. And then I'd maybe have a little bit of money that I leave for individual stocks, but only a very small amount. And I think if you think about that, like, what are you actually trying to do with your portfolio? You're probably trying to invest in a way that grows wealth over time consistently. You're taking some risk by investing in the stock market or whatever, but you don't need to swing for the fences anymore. And I think that's what this quote is about. It's about not necessarily trying to shoot the lights out. It's just about trying to avoid mistakes. And that's why I love just this one quote that I think I could double click on again. So don't forget, next week we've got Pete Wargent. Many of you know Pete. He's a 7-time author now. He's also a co-host on the Australian Property Podcast. So we'll be talking about not necessarily the debate between property versus shares, but the ability to use property and shares. And I'll give you a good example. A good example of this is kind of like one of the regrets that I have, and the regrets is what we touched on in this form here. If you haven't already had a chance, please take some time today. I'll pop it again in the chat. I'm going to share the results from this in the next, probably early next year. But one of the regrets I have is that I put all of my money into investing early in my 20s. And while that might sound like a good thing, and it was a good thing, it wasn't the best thing that I could have done. The best thing I could have done is I could have bought a property and then redrawn that equity. So you use the money to buy the property, and then you draw a line of credit back off that property once you get equity in it. And you use that equity to buy shares and ETFs, because the line of credit that you pull back from the property is tax deductible. It's at a lower rate of interest than any other type of loan because it's secured against your property. And you can earn franking credits if you select the right ETFs or shares. So that's probably, it's not necessarily that I made a mistake in my 20s. It's just that if I was more proactive and thought more about how I can use property and shares, I would have been far further ahead than I am today. Far, far further ahead. And that's just an example of what I'm trying to capture in this survey. So if you do have 5 or 10 minutes, maybe you do it today, maybe you do it tonight, please take some time. I'd really appreciate it to share what you have learned and what's worked for you. So we'll be talking with Pete next week. Pete's got a few books. I think his first book was Get a Financial Grip. He was financially independent, I think, at 33 years of age. So he effectively could retire. And I'm sure we'll get to this next week. But nowadays, Pete has 15 properties, I believe. And he's not one of these people that just go and collect investment properties and brags about it. But I say that because he's actually very accomplished in what he does. And he's very effective in the way he's used both shares and property. And he's a big proponent of index funds early in his life. And then finally, we'll finish with a Christmas special where we'll review the year. So that's it from me for today. I can see Octavian said, would you consider the quality ETF a core investment? And how would you rate the quality ETF? That's a good question, Octavian. Obviously, quality is from Betashares. I think the quality ETF is actually one of those really hard questions to answer because the ETF itself is actually quite low cost. So you could almost put it in the core of your portfolio, but it could also be considered a satellite position because it also does something that's different to a lot of people's core. So it all depends on the makeup of a portfolio. And for example, if you use the quality ETF or any quality factor ETF, you've got to just be aware of the overlap between that ETF and the remaining part of your core portfolio. Because say you had the S&P 500 and it's got Apple, Microsoft, I don't know, NVIDIA, so quality companies according to the quality ETF. So they might be included in both of your ETFs, in which case you're doubling up your exposure. So you've just got to make sure that when you sit down and go, I want to put 30% of my money, for example, in international shares, you've got to make sure that you don't have all of a sudden 40% because you've added another ETF, which you thought was different, but it ended up investing in the same things because some of the companies that are inside the S&P 500, for example, are also inside the quality ETF. That's probably the first thing to do is like to know your top-down strategy, like how much am I investing in this asset class, how much in that one. That's the first thing. Obviously, that relates to the long-term risk profile and your long-term financial goals, which I do not know. And then from there, you go, okay, well, how much do I want to spend in fees within that portfolio? Like what am I willing to allocate? Obviously, in the satellite, as I've said in the past, I'm much more willing to have high fees. In the core, I'm willing to have high fees, but only if it gives me something that's unique. Fortunately, with the quality ETF, it's actually not that high in fees, which is why it could kind of, depending on the investor, it could probably go either way. But it is one of those ETFs which is hard to nail down because it basically depends on the investor. I hope that adds some context to how I think about it, Octavian. And Hammer, you did say ShareSite now does a nice report to show you overlap percentages within your ETF holdings. Yeah, it's a great report. All right, guys, so I'm back next week. We've got 2 more sessions before the end of the year. For anyone that's watching this back on replay, the next show will be at 6 p.m. next Wednesday night with Pete. So you can check that out live at 6 p.m. Australian Eastern Time with the great Pete Wargent, the property wonder, which is Pete Wargent. We'll have a bit of fun with that. We'll ask Pete some really hard questions together. I'm sure he'll get a laugh out of it, and we'll have a bit of fun. And then the following week, I might even get my my elf hat out and we can have a bit of fun for a year in review, a Rask year in review. So that's all for today. Thank you, everyone who joined us live. Thanks for everyone that asked questions. Hammer, Karina, everyone, Octavian. Thank you, guys. Thanks, Rob, for joining us from Selfwealth. Don't forget, Selfwealth is a partner of Rask Live, and you can check out Selfwealth and get 10 free trades when you sign up. All right. Bye for now, guys. I hope you enjoy your wonderful Wednesday, and I'll see you next time.